Hello, everybody. Welcome to another great Women's Council of NAREB topic. And today our session is all about buying your first home or buying a home for zero money down, whichever you prefer. Today we have some wonderful guest speakers with us. We have our financial educator, Crystal Berry. Hey, Crystal.
Hey.
And we have joining us two special guest speakers, both from Fairway Independent Mortgage. We have Tina Vorraro. Hey, Tina.
Hi.
Welcome. We're glad to have you here today.
Thank you.
And we have Chris McBrearty. Hey, Chris.
Good morning. Thank you for having me.
Thank you for joining us. And it looks like you're enjoying a nice day out in the mountains from your background. So today's topic, we're going to talk about USDA loans, CalHFA loans, how you can qualify, and some options for zero money down. So we're going to go ahead and let's keep going here. Buy your home for zero money down with CalHFA loans, USDA loans, and down payment assistance programs. This topic is presented by Women's Council of NAREB San Diego chapter, and our three goals are home ownership, financial literacy, and college scholarships. So welcome everybody. Today is Saturday, March 21st. And our mission at Women's Council of NAREB, as we said before, we're an organization. We're a part of National Association of Real Estate Brokers, NAREB, San Diego Chapter Realtist, and we are a 501c3 nonprofit organization. And we have a mission to elevate standards of women in the real estate industry by encouraging leadership, education, and the exchange of information through group learning techniques. We also have a mission to educate minority and low-income neighborhoods about finances, home ownership, and property acquisition. And last but not least, empower students by raising funds for college scholarships to benefit minority students in completing their higher education. With so many challenges in today's climate, as we know, you have every reason that you could have used as an excuse to fail, but instead you have taken those reasons and you're using them to succeed. So good for you. Remember, it's never too late to start and it's never too late to finish what you started. So start today. Today's topic, buy your home for zero money down, will be brought to us by Chris McBrearty and Tina Vorraro, mortgage loan professionals at Fairway Independent Mortgage Corporation, as well as Crystal Berry, who is a real estate broker and certified financial educator. She's going to discuss the steps to home ownership, the path to getting qualified, and me, Regina Brown. I'm a college professor and a certified financial educator. I'll share financial affirmations to help you stay on track, as well as some down payment assistance tips. So we do have a little poll here. What's the best day to attend a financial workshop? Now, when we gave the poll last time, most people said Saturday mornings. A few said weekday evenings. And if you have any more feedback on that, we would love to hear that. But now it's time to get out your notebook and take notes. We're going to have some home buying tips, how to get your piece of the American dream. We have Tina on CalHFA loans. Tina is a mortgage loan professional. Before we get started, maybe if you wouldn't mind just taking a moment and giving us a little background about yourself.
Hi and welcome everyone. My name is Tina Vorraro. I've been in the mortgage loan business since 2002, so I've been around for a little bit. I know for some Homebuyer programs, I'm also knowledgeable in FHA, conventional, and jumbo loans. I've been working at Fairway Independent Mortgage Corporation for the last 3 years, and I'm happy to be here to help you understand the CalHFA loan program.
Thank you. We appreciate your expertise. Okay, I have on the slide some talking points that you're going to share with us. So go ahead, Tina, and share with us whatever you like to about the CalHFA loans. It's spelled CalHFA. I know some people think it's spelled a little differently. It's a little confusing, right?
A little bit, yes. Now, let me just give you a little bit of information about CalHFA. It's the California Housing Finance Agency, and they were founded like 40 years ago, and they help first-time home buyers get into their home with little or no money down. The program has made a lot of changes recently, and so the down payment that they combine with the closing costs, the maximum is 6.5%, and the loan to value goes up to 105. So what that means is that these borrowers can get 3 loans. One is for the monthly payment of the 97% or 96.5%, depending on which program we go. Then there is 2 other loans that will help with one is for the down payment, and the other one is for the closing costs. So someone who has very little money, say $2,000-$3,000, can get into a home. And the payments for the second and third are silent. So that's the beauty of this loan. Their silence, second and third, are not due or payable until the first loan is paid. So that's a huge, savings for some other people that can't afford the regular, loans.
That is a
Also,
huge savings because they only have to pay a payment on the first mortgage.
that's correct. That is definitely correct. Now, the minimum FICO scores for FHA is 660, so you can go as low as 660, and the minimum payment for conventional loans are 680. So someone who doesn't have a 700 FICO score can still afford to buy a home. And CalHFA is the easiest, in my opinion, to get help with down payment and closing costs. They never run out of money. They just never do. They always have money, so you never have to worry. Some other programs, they run out of money, you have to wait, you got to go on the waiting list.
Yes.
This program does not.
That's awesome.
Does not at all. Yes, it is really, really good. Now, let me just go over a little bit about the ways that CalHFA determines if you qualify. We as a lender will submit the loan to our underwriting. They will calculate the income for the underwriting purposes. Then CalHFA will determine the eligibility income, which is different from how we calculate income to qualify for a mortgage. So there's 2 types of calculations that we have to do. But CalHFA income requirements are pretty nice. In San Diego, that's 183,000. Someone can make up to 183,000 and still qualify for this program.
Oh, that's wonderful.
Yeah, right. It's really good. Other programs, you have to make, 80% below AMI and things like that. This program, it's, in Southern California, the homes are higher. So, you need to make more money in order to qualify for those homes. 183,000 this year. So that is huge benefit for the consumers and for the borrowers, to get into their first time home. The negative for this loan is that if you're not on the loan, you cannot be entitled ever until you refinance or you pay off the mortgage.
Yeah, that's a small price to pay for a great loan, though.
It really is. I do this program a lot, actually, because more people fit into this program than other programs. They can get into their first home. You can go, as you can see, you can go USDA, Fannie Mae, VA, FHA, and this program will help you with the closing costs. And if you don't need the down payment because you have the down payment, but you don't have the closing costs, this is perfect for them. I just love this program a lot. I use it all the time. That's my go-to program because it's easier to qualify more borrowers.
Okay, that's great, Tina. Can you tell us a little bit about maybe a story of somebody that you had who got into one of these CalHFA loans and, you know, a little bit about how they got in and that type of thing?
Yes. Well, I just forgot to mention that they do need to do first-time home buyer education. Okay, that's very essential to this program.
Do they offer their
Yes.
own educational program, or can you take the first-time home buyer program anywhere?
No, you would have to go onto their website and click on that link, and then it will direct you to the approved education programs. And I believe that's a cost of $150 for them. It's like a little investment for them to make sure that they are really, interested and really wanting to do this. So that's how it starts. That's how it works. I usually have a borrower make that first to see if they really are interested in purchasing a home. Okay, let me give you a little story about a borrower who wasn't able to find anyone to take, his offer. He didn't have a lot of money, but he had a little bit of money. He had like $5,000, and he bought a home in Hesperia, and the homes over there are a lot less money. So he was able to qualify with his son. They've been looking, and everyone kept turning them down, and I don't know why. Some people don't know about CalHFA, but they didn't know, and they didn't have enough money. Because right now it's a seller's market, and so with me kind of helping them with the closing costs, that made it more affordable for them because they didn't have enough money for the closing costs, but they had money for the down payment, which is great. So we gave them a loan. They closed their loan about maybe a month ago, and they're so happy because they've been trying to get into a home for years, literally years. Saving money is not that easy here in California. I know you got to pay rent, high rent, and so they've been saving their money for so many years to finally get it, and they are just so elated that they're able to have their own home, and now they're painting it. They sent me a picture of what they were doing, painting, doing the backyard. They're just so happy. That is why I do this loan, because people who can't afford it, but they don't have closing costs, or they may not have a down payment, and now they're in their home. That just makes my day.
That's awesome. Thank you, Tina, for sharing that wonderful success story. And you mentioned how hard it is for people to save for a down payment in California, especially there's so many high cost areas, San Diego and anywhere on the coast, most major metropolitan areas. The cost of living is so high that people who are renting spend most of their income paying their rent, and there's little left over to be able to save for a down payment.
That is so true. That's why this program works. It'll help you with the down payment.
Right. Okay. So the down payment, what would you say is the least amount of money a person would have to come up with out of pocket for down payment / closing costs with the CalHFA loan?
Like maybe $3,000.
Oh, wow. Okay. That's awesome. $3,000. And can that be a gift from a family member, or does it have to come from their own savings? Or
no, it can be a gift. It can be a gift. They will accept gifts.
Okay, wonderful.
Yes, it's really, or if in another time, maybe a couple of years ago when it was a buyer's market, I was doing loans with zero down because the down payment system will help and then closing costs. And if they needed any money for the additional closing costs, we needed money for that, the seller will kick in and pay. So zero. I was doing loans with zero money down.
That's awesome. So you can actually work with a realtor who can structure the deal so that the seller pays part of the closing costs or gives the credit to the borrowers, essentially making, a very low out of pocket for your buyers / borrowers, or maybe even nothing. That's wonderful.
That is correct. This is a really good program. Really
awesome. And I heard that you said you work with down payment assistance programs as well, right?
Right, that is correct. The only problem with, there's a lot of them, and some of them I have done in the past. It's just that you have to fit in that little box
Right.
with the, and it's harder. The income requirements are so much strict
Right.
than this one.
That is true. And some of the down payment assistance programs do run out of money, which we will be talking about those programs later today. But thank you, Tina. That was really awesome. Does anybody have any questions for Tina? Crystal or Chris?
No, I don't have any questions.
Tina, you can work with Spanish-speaking borrowers as well, correct?
Yes, I can. Yes, I do speak Spanish.
That's a huge
That's really good.
advantage.
Yeah, it is actually. Comes in handy.
Okay, wonderful. Any other comments or closing thoughts, Tina, before we move on?
I saw the DTI requirement is 45 above the average, right?
You're asking about the debt income ratio is 45?
Mm-hmm. Is that higher than
Yes.
the average?
It is, it's right, I'm going to say it's in the middle between the down payment assistance, the other down payment assistance are usually 43%.
Yeah.
And this one goes up to 45, which helps qualify, a little bit more. Was that your question? I don't know. We're kind of mumbling.
Yeah, that's fine. The answer is good. Thank you.
I do have one more question, Tina, and it says LTV loan to value as high as 105. I know you spoke about that a little earlier. Does that mean if somebody wants to, say, buy a house and it needs some improvements, that they might be able to get a little bit of cash back to do a couple of improvements or renovations around the house?
Yeah. The reason why it's 105 is the down, an example, let's just go with FHA because that's easy. FHA requires you to put 3.5% down payment, and CalHFA will loan you. They're loan. They'll loan you the 3.5. So it's 96.5 plus the 3.5, and then if you need 3% for closing costs, then that's added on top of all those three loans. So that's where you get the 105% loan to value. Because they're considered silent seconds and thirds, but you're adding them to the loan, and therefore we have to calculate it that way. Now, what you're talking about is like a 203K, which is a rehab, an FHA rehab loan. Those are different.
Yes. Okay. That
From
makes
this.
sense. It sounds like you're having really wonderful success with your borrowers, Tina. So awesome. Yay. Keep going strong.
Thank you.
And now let's keep moving here because we have another wonderful program to talk about. And we have Chris McBrearty, mortgage loan professional, and his topic is USDA loans, which are very unique in that they are government funded and they actually have zero down loan program. So that's why they're featured here today. So he has some great talking points. So go ahead, Chris, talk about.
Hey, thank you.
If we could
Thank you,
just hear a
guys.
little bit about your background first, that'd be great.
Okay, it's easy. At the age of 16, I took a job as a telemarketer for a real estate company, inviting apartment dwellers to first-time homebuyer seminars. And that was about 31 years ago, and I've never, ever looked back. I've never done anything else. I live, breathe, and eat real estate.
That's awesome. So you're completely vested in the real estate industry and serving buyers and sellers and, homeowners and borrowers. That's awesome.
Even my kids are homeowners. So yeah, I'm a firm believer in home ownership. It is the most prolific way to stay out of debt,
Mhm.
to utilize real estate as wealth that you can pass on.
Wonderful. Yes, Crystal and I are also big believers in the American dream of home ownership. And for many of us, for our families that may not have acquired or, been able to save up money over the years, we realize that owning a home is the best investment because real estate appreciates over time, and it's actually the key to wealth for many families. So thank you for your dedication to our cause here.
Thank you. A little bit of background on the USDA. USDA is exactly what you think it is. They are the same people who stamp your meat. They are the same people who oversee the process of making orange juice and eggs and
U.S. Department of Agriculture.
Yep, the United States Department of Agriculture. Well, back in the 70s, they were also tasked with providing rural home ownership opportunities closer to the farms and the rural outskirts of cities like San Diego, so that they could diversify the type of home ownership going on in those areas and hopefully bring new thoughts and ideas and technical workers to the farmlands. And that eventually transpired into an incredible opportunity for people to understand what it's like to live in rural America. So the program took off really in the late 80s and early 90s. It used to be up until about 95, 96 that almost annually the program would run out of money because Congress would only allocate so much until the money got usurped. And then in the Clinton administration is really when the Clinton administration was very big on home ownership. And one of the programs that they really funded greatly was the USDA program. They changed the guidelines. They made it a lot more accessible. They made it a lot easier for people to understand, and they made it a lot more affordable. So since then, it has run out of money a couple of times, but that's mostly because our people in the Senate and Congress can't get their what together to keep funding the government forward. But for the past 10 years, it's been pretty consistent. The USDA has been a wonderful go-to option in the more rural parts of America to promote home ownership. So I want to talk about some of the pros of the program. There are some cons to it. It's just like Tina said, our earlier speaker, it's got a box that you need to fit into. So the USDA is not just for first-time home buyers. While you cannot own a home and utilize the USDA to buy another home, it's not just a first-time home buyers program. You can have had previous home ownership. The financing is 100% financing. It literally requires zero down payment. The interest rates are incredibly low. It's very similar to FHA and VA. It's also credit score based, just like FHA and VA. Risk-based as per, minimum credit score of 620. And obviously, if you're up at a credit score of 780, you're going to have a better interest rate. The mortgage insurance, we like to talk about mortgage insurance a lot without spending 10 seconds to explain what it is. Historically speaking, prior to the advent and proliferation of all these government programs, FHA, VA, and USDA, we used to base the bar of home ownership on conventional lending. And years ago, conventional loans required 20% down. And if you ever wanted to put less than 20% down, you were going to be subject to paying mortgage insurance. That is still the case today, and it's the case also with government loan programs, with a few exceptions. With USDA, the two types of mortgage insurance are very similar to FHA and VA. You've got an upfront, what we call a funding fee, or an upfront mortgage insurance premium. That amount for both FHA, VA, and USDA gets added to the loan amount. So in this example, for USDA, it's quite a bit less than both FHA and VA. It's only 1%, versus FHA and VA can be, up over 2%, 2.75, or subsequent use for VA can be even higher.
Wow, that's a great benefit.
Yeah. So an example would be if you were to, I'm just using whole numbers, a $400,000 loan for USDA, it would be $4,000. So by the time the loan closes, the loan amount would not be 400, it would be 404,000 or 404. Now you compare that to FHA, where you're going to be at, over 410,000. So USDA is an incredible option versus FHA and VA. What's more is the seller can pay closing costs, making this the potential for zero out of pocket. What do I mean when I say the seller can pay closing costs? Regina, you brought it up just a second ago, where if the realtor is negotiating and there is some room to ask for the seller to pay some closing costs, that can happen with USDA, and probably happens with about 50% of the deals.
Oh, that's great.
Yeah. We were talking about cash in with Tina as well. And I think the main thing about cash right now is a lot of sellers aren't going to take you seriously if you don't have some skin in the game. So I'm seeing a lot of very heavy deposits being favored over deals that don't have a lot of deposit. For example, if there's 3 offers coming in on a property, and one is a conventional loan with 5% down, and one is a VA loan with nothing down, and one is a CalHFA deal with, 105% financing, I think the seller is going to put a lot of weight on how much of an actual deposit you're going to be willing to put into escrow.
That's true. They do want to see that the buyers are vested in the process, but also I think it may come down to the negotiation skill and the relationship that the buyer's agent has or is able to develop with the listing agent. In other words, going to bat for their client and showing how their buyers might be either more qualified or some reason why the sellers would want to pick their buyers over other buyers.
That is correct. And it is a skill set, and it requires personality, and it requires presenting. We call it presentation. We work with agents to try and nail that down, because it's very important for especially USDA and CalHFA that somebody educates that listing agent. A lot of listing agents just haven't seen deals like that. And it's important to get your loan officer involved and have a loan officer that's willing to talk to that listing agent to explain exactly what we're talking about.
Yes, education is key, because when people are unfamiliar with something, they'll tend to, sort of not take it as seriously as something that they're more familiar with. So, and I appreciate you being here today, because this is great education for all of us as well in the industry.
So let's talk about some of the cons, and really they're not cons. Let's just call them challenges or sides of the box that we need to work with. You see on there, I've got a debt to income ratio of 29:41, and it is strictly adhered to. There are certain exceptions. So the 29:41, what are debt to income ratios? Well, when you have a housing expense or proposed housing expense, we weigh that against your total gross income. So in this scenario, if you have a housing expense of $2,900 a month and you're making $10,000 a month, then that would be considered a 29% debt to income ratio. And then you see another ratio there of 41. Well, that's your total expense. So it's your housing expense plus your car payments plus student loans, any kind of stuff that you can find on your credit report.
So basically,
that's what
front end and back end.
Front end and back end.
Okay.
Now, I do say strictly adhered to. There is some movement there. It's the USDA has its own automated underwriting program, which is unique from FHA, VA, and Fannie Mae. And we have seen some debt to income ratios as high as 45% in the back end. We've seen front ends as high as 33. However, it's few and far between. Those people generally have a higher credit score. They generally have pretty good credit depth and credit history, and they usually have some kind of money in the bank. So the automated program is going to weigh all these different things to help us come up with what those figures are. But when I'm helping people plan for their future, I generally stick to 2941. One of the major restrictions is we are limited to the more rural parts of the county. If you have an address that you're concerned about, or you're wondering if your address would qualify for USDA, it's pretty easy to do a Google search. You just Google USDA property eligibility, and you will see the USDA screen come up. You can pop in your address, and it will tell you whether or not that property is eligible. And I'm always pleasantly surprised at how surprised some of my homeowners are and some of my realtors are that their listings fit within the USDA guidelines, within the eligibility area. The income limits are very strict. It's 115% of the county median income. The USDA is trailing a little bit behind the rest of some of the more progressive programs like CalHFA. So the 2021 figures haven't come out yet. We're still stuck with the 2019 figures based on the area median income of 2019. I'm not exactly sure if that's good or bad, because if they're going to go with 2020, well, we all know what happened in 20. Am I still muted? No, okay. So to give you an example, USDA goes with family size for minimum income. For a family of 1 to 4, the minimum moderate income or the maximum moderate income is $136,500. And when you think about that figure and what you can qualify for in some of the less expensive areas of East County and rural North and Northeast County, it's actually kind of a perfect storm for a lot of home buyers right now. The interest rates are incredibly low. I mean, we're at, 3 to 3.5%. You can have a high income limit. And if you've struggled to save a down payment, this may be a great program and might make it so that you can fit into a $550,000 or $600,000 home and still have your payments be below $3,000 a month. The appraisal is subject to similar FHA and VA restrictions. Generally, what FHA and VA are looking for in appraisals is mostly hazards. They also don't like peeling paint, and they don't like evidence of roof damage or previous water leaks, that kind of thing. So those are the majority of the cons and the difficulties or some of the challenges when we're talking about USDA. And again, everyone's unique, and it isn't a fit for everyone. You can certainly use USDA in certain cases where other people may not even be able to qualify for FHA or VA or conventional. We'll talk about some of those in a minute, but I'd like to give an example of a family that we just closed on about a month ago.
We'd love to hear about it. We love those success stories.
This is so much fun. This is a young family, absolute beautiful family. If you were to try and take the multitude of cultural backgrounds of everywhere in the United States of America and shove it into one family, that would be this family. There is a rainbow blowing out their windows that just shines as bright as can be, because they really have a great representation of homeownership in the United States of America. They were located in Las Vegas. The husband worked for the Las Vegas Airport Authority. He was offered a position at the San Diego County Regional Airport, making a lot more money. So about a year and a half ago. He came from Vegas with his lovely wife. She is what you call a doula. She's a home birthing specialist.
I've heard of that, sort of like a midwife.
Sort of like a midwife who is a lot more knowledgeable, I guess you could say, or a midwife that's got a certification.
Actually, our son and daughter-in-law just had a baby on Wednesday, and they had a doula, and they were very excited about her and the level of professionalism that she brought to the whole birthing experience. So
Yeah, I mean, just the calmness and the coaching, and it doesn't stop there. Even afterwards, she's still with you for, I mean, she almost becomes a part of your family, working with you to make sure that, the baby's well fed. And anyway, she's an amazing lady. I can talk all about her another time. But curiously, what is extremely unique about their situation is they have several adopted children. They have 4 adopted children. Well, with their adopted children, and they also have foster children, with their adopted children comes unique types of income from the state of California. And that stuff is very technical income. It's from the Health and Human Services Department. It's handled through the County of San Diego. And if you don't understand it and understand how that fits into income guidelines and maximums, then you're going to get turned down. Most loan officers are just going to turn you away. So at Fairway, with the help of Tina and a few other loan officers, we understand that stuff. We get it. We've seen it. We were able to help them get their income together and fit inside the box and figure out how they could go and buy a home. They were able to, with their income and their family size, they were able to qualify and purchase a $725,000 home, brand new in Fallbrook.
wow.
Yeah. And their combined mortgage payments, because of the way that we structured it and buying the interest rate down, using seller credits and a few other things, we were able to keep their mortgage payment down to like $3,800 per month for a $726,000 or $725,000 home.
Wow, and room for all their children.
Room for all their children. Brand new home too. So
Wow.
the warranty and they call me once a week. I mean, they call me and it's just laughter and beautiful, sounds of children in the background. It's really cool. I can't go see them yet because of the times that we're in, but
Yes, but still, I'm sure that warms your heart, and it brings you a lot of satisfaction knowing that you helped a family that really was truly deserving and maybe didn't have any other options as far as conventional loans or standard loans or something like that.
yeah, it was a real blessing to be involved in that one. That was fun. So let's talk about some of the creative strategies that we've used utilizing USDA just in the past 12 months. The first thing I've got on there is combined households. And what I'm seeing a lot of now, I am a father of 6, and 5 of my 6 children are adults. 2 of them are married, and they've got lots of friends that are in the similar boat. So one of my daughters is married to a wonderful man, and they've got friends that are in a similar situation, and housing just seemed like something that was just totally out of reach for them. So what I'm seeing a lot of right now in young people, particularly under 40, is young couples getting together and buying that first home together. They can combine their income to help qualify. They can combine their resources to qualify. They can utilize their special skills to, paint and fix up homes and do that kind of thing. And they're getting into these homes and they're occupying them for 2, 3, 4, 5, 6 years. And at the end, they've got a strategy up front where one of them buys the other out, or they both sell it, or they rent it out and move on to the next one, or, whatever seems to make sense at that time. And you can do that with USDA. You can buy a home in Ramona, for example, that's a little bigger than something that would be in San Diego. And you can you can live on either end of the house or on either floor of the house, and you can do it comfortably. And I'm starting to see that happen. It's a unique situation, but it's something that can happen. It's something that you can present.
Yeah, it's good, especially if you find a property that can be divided up easily, maybe a duplex or
Yeah,
something with the upstairs and a downstairs.
yeah, yeah. Or something that's got a larger lot that might, maybe you can put an ADU on it in the future.
Right.
Conventional fallout. What do I mean by conventional fallout? Sometimes at a particular credit score with a particular down payment, let's say 10% or less with a credit score below 680, sometimes a person who wants to put 10% down into a conventional loan with a credit score below 680 is not going to fit, because their mortgage insurance is going to be rather high. And with the risk-based pricing associated with conventional lending, their interest rate's going to go up as well. Well, with USDA, the mortgage insurance and the interest rate at that particular scenario would be lower. So just because USDA offers 100% financing doesn't mean that you can't put 10 or 5 or 6 or whatever percent down that you wish to. So we have been able to look at, particularly in Fallbrook and Julian, people who were coming in thinking they were going to purchase conventional, and then it kind of worked out that it was a little better in the monthly payments for them to go with USDA. Maybe the credit score turned out to be lower. Maybe the mortgage insurance turned out to be lower. So it's just another tool in the another arrow in the quiver that we can utilize. And then, of course, folks without the ability to save, that family I was telling you about, they actually did have the ability to save. However, their loan technically could have been considered a conventional fallout because they were looking at doing a 5% down conventional. But when we weighed the options of the mortgage insurance and the credit score and the interest rate and the monthly payments, it actually was cheaper for them to put 0 down, save their 5% so they could buy furniture and, you know, do landscaping in the backyard and have a lower payment with the USDA. Even though they put 5% less down, the payment was lower than it would have been on conventional.
Oh, wow.
Yeah. And then as third parties, realtors, sellers, lenders, we can all help contribute towards the closing costs. It's, you know, going to get paid for somewhere generally. I explain that to most buyers that, you know, can the realtor use their hard-earned money to help you get in? Yes. It's generally something that isn't happening a lot right now. As well as seller contributions. Seller contributions are a little bit unique right now. They're kind of hard to come by.
Well, it's a seller's market, so I guess
it's a seller's market, and same with lenders. You know, 2 years ago we had a lot of margin and room in our deals where we could make contributions. We could increase the interest rate and utilize the extra little bit that we were getting back. Well, that's not happening today. There's just not a lot of margin available. It's just the way the pricing is happening on the secondary market, and that literally could be a whole nother seminar.
Right, it sure could. Well, with the real estate agent being the, you know, the sort of the person who helps them navigate this whole situation, maybe provides them or access to a great lender like you and Tina, and goes to bat for them with the sellers and the listing agent, you know, that person is very vested in the success of their buyers. And we have seen in the real estate industry, as they call it, commission compression.
Yeah.
Sort of like what you're seeing in the mortgage loan industry as well, is that commissions are generally getting smaller. But even with that, I think a lot of realtors and you know, real estate agents are willing to help their clients because they're very vested in their success. And honestly, if they don't close the transaction, they don't get paid. So they, they get zero. So for them, it might be worth it, even as a business decision, to put a little bit towards helping their clients out. And,
I think it just depends. I mean, every scenario is completely different. Every scenario is completely different. So, and you just got to treat it like a thumbprint and a unique situation, and kind of cross that bridge in the front end when you're talking with the client, because some clients are just like, look, I just don't have any money.
And that speaks to the unique nature of what we do, and why, not to get off on another topic, but why computers will never be able to replace what we do, because each family is different, each situation is different. We have to know a myriad of loan products and strategies and techniques. So there's a lot involved, a lot of advanced, thinking, and more complex, different nuances, different levels, and different factors that go in. So that speaks to, what we do as professionals.
It sure does. It sure does. And thank you very much for adding that. There's no substitute for experience. None.
For sure.
I just, in closing, I'd like to tell anyone who's watching this now or in the future that what you see here is a lot of figures, and it's a lot of information, and it's just the tip of the iceberg. And we only put it out there to try and help you realize that if you really truly want to be a homeowner, if you really truly wish for that kind of wealth, and it's generational wealth that you can pass on, then you just need to pick up the phone. You don't need to worry about any of this stuff. We put a lot of figures out there. I don't want you to think that because you make more or less, or you don't understand DTI, that you shouldn't pick up the phone and call somebody. Call Regina, call Crystal, call your realtor, call Tina, call myself, call somebody, and start asking questions, because this is what we do. We love it. We love this. This is our passion. This is not just a job for us. This is something that we enjoy getting up and doing every single day, including Saturday and Sunday. So don't feel, the number one thing I hear from especially young people is, I just feel so stupid. And it's not about being stupid. It's naive. And really, there's only one stupid thing about any of this. The only stupid question about homeownership is the questions that you're not asking us. That's
right.
That's the only way I can put it.
It's about education, reaching out, being proactive and exploring your options, comparing different situations, and understanding the pros and cons of each as you've laid out for us. Thank you, Chris. That was wonderful. I'd like to expand a little bit on one of the main topics for the USDA loan, which is location. It's limited to rural parts of the county. So first of all, thank you, Crystal. She has in the chat the link, so somebody could easily use that link, which we will post again, to determine whether their property fits in that area. Now, some of us may serve more than just San Diego County. For example, Crystal, I know, serves as well as Riverside, San Bernardino area, and I know in those areas there are many more rural parts, especially the high desert. Tina, I think you were mentioning your clients in Hesperia, right? Which is the high desert. And so you know, in the high desert, you have Victorville, Apple Valley, Hesperia, Adelanto, Phelan, all those areas. And I think most of that area is considered rural, as well as many other parts of San Bernardino County, Riverside County. So maybe you can speak to that a little bit, Chris. I don't know if you serve all those areas.
I do, and thank you for asking. You never know when you get on a Zoom call where your focus is. But yes, I'm licensed to utilize this product statewide, all over California. Tina and I both service all of California. We've done these loans in the vast majority of the Southern California counties for sure. I've got all the way from San Luis Obispo to off of Highway 395 and all over Riverside and San Bernardino. And yeah, so if you are in those counties, in fact, in many cases in San Bernardino and Riverside counties, there are more opportunities, as in more homes that are within the eligibility area than we have in, say, San Diego. And other counties like Orange County doesn't even have any eligible areas. They're just non-existent. Or if they are, the homes are just so overpriced there, or just too expensive there.
Right. That's definitely not the target for this loan. But I'm originally from San Luis Obispo County, so I know that's a semi-rural area, and many areas of the county qualify for USDA loans there as well.
Yeah. Yeah. So again, if you're in California and you have questions, especially about your county or a home that you're interested in, text us, call us, email us, anything you need to do.
I think people would be surprised to find out how many geographic areas in California are actually considered rural, because you think, oh, everybody lives in a big city, but not everybody does. Actually, most of California, land-wise, is rural areas, whether it's a forest or the mountains or the desert. There are many areas, including where you're at now in your nice little mountain picture behind you. Crystal, do you have a question or thoughts?
No, that was actually really, really good information. I have a client that I really wish was on here to hear it, but I'll send her the replay because it was really good. But no questions. He covered everything pretty thorough.
Okay, great. Thank you so much, Chris, for explaining the USDA loan to us. We realize that there are so many different features and benefits that we didn't know about. So we appreciate your education and we appreciate you being here today.
Thank you very much. I appreciate it.
Okay, that was a wonderful presentation from Fairway Mortgage from both Tina and Chris. So thank you both for joining us. Now we're going to move on to the next phase of our topic, which is purchasing a home. What are the steps you need to qualify for a loan? And we have our resident financial expert with us, Crystal Berry, who's going to share the next phase of this. So Crystal Berry is a certified financial educator, and she's going to show us how to dream big and plan your financial strategy to have your best year yet in 2021 and beyond. So she will share with us now. So let's, I'm going to stop sharing my screen. And can you share yours, Crystal? Are you able to, does it let you share?
It says disabled screen sharing.
Let me see what I need to do to make sure that you can share. Advanced sharing options. Oh, all participants. Okay, I gave you access to be able to share. See if it works.
Perfect. I'm sharing.
Oh, yes, can you do it? Can you share it the other way? Yes, there you go. Awesome.
So I have a lot to cover, so I'll go pretty quickly because there's about 20 slides.
Yeah,
So.
No worries. We want to hear, all your great feedback. And
Okay, it kind of piggybacks on what Crystal was talking about earlier. This is going into FHA loans and how to qualify for a home loan, what you need to have. So with FHA loans, they're great for first-time homebuyers. They are federally backed loans, and they require a credit score starting at 580, which can get you as low as 3.5%. It says interest. I think the national average is about 3.24 right now, but that's going to depend on your credit score, of course. But you can put as little as 3.5% down on a home with the FHA loan. The FHA loan does have some restrictions, so no foreclosures within the past 3 years, and the maximum loan amount varies based on your area, your location that you want to live in and county. So there's two important ratios when applying for a loan. There's the housing expense income ratio and the debt to income ratio. With the housing expense income ratio, it's where your housing cost is compared to your gross income. And with the debt to income ratio, it's where your obligated debt payments compared to your gross income. So there's a lot of different ratios that have been brought up. I'm not sure if you're familiar with the 2836 rule of thumb, but it states that your housing mortgage should not exceed 28% of your gross income. And gross income is what you bring in before taxes are taken out. So that's a rule of thumb when determining how much home you can afford that you can use when creating your budget for a home. So that's just one thing to keep in mind. With the housing expense ratio, your total monthly housing costs is divided by your monthly gross income. Your housing expenses will include your principal, your interest, taxes, insurance, and HOA fees. Housing expenses don't include your maintenance, repairs, or deductibles, so you want to keep those in mind when creating your budget and make sure to save for those things. The lower the expense to income ratio, the better. So here's just an example of how to calculate your housing expense ratio. You'll want to figure out what your housing expenses are and divide that by your gross income. And remember, your gross income is what you bring in before taxes are taken out. So for example, if your expenses are $1,200 per month and your gross income is $4,000 per month, you'll want to divide that, and that's going to give you 0.3. And this is a chart showing you where you fall with the 0.3 ratio. So 0.3, 0.5 is critical, 0.31 is priority, 0.28 is important, and 0.25 planning, 0.2 is maintenance. So debt to income ratio, which is the most popular, I think that everyone has heard about, is the total obligated monthly debt divided by your gross monthly income. So your obligated debt includes mortgage, your rent payments, credit cards, installment debt, car loans, student loans, and consumer lines of credit. Your obligated debt, like I mentioned earlier, does not include expenses like groceries, utilities, entertainment. Those are not debts. So those aren't included in your debt to income ratio. But you want to factor those in when you create your budget as well. Your debt service ratio is calculated by dividing your monthly debt expenses by your monthly gross income. So for example, if your debt expenses are $1,700 per month and your gross income is $5,000 per month, that's going to leave you with 0.34 or 34%. So there's different ways that you can check what your credit score is. You can go through TransUnion, Equifax, Experian, FICO, or Vantage Score to check your credit score. I feel like I'm missing a slide. So with FHA loans, they may allow for a lower credit score. So if you have a credit score between 500 and 579, you can pay 10% down. So for example, if you're looking at a $400,000 home, that would be about $80,000 that you would have to save to put down if your credit score is between 500 and 579. If you have a 580 plus, you can put down as little as 3.5% down on the home. Other lenders do require a higher credit score, 620 and above. If your score is low, you can request a free credit report and you can take some steps to improve your credit score. So some things that you can do is to check for errors and have them removed. You can avoid utilizing your full credit limits and bring all your payments up to date. So those are some ways to quickly increase your credit score. The process, so getting pre-approved for a mortgage. The pre-approval, when you come to meet with your lender, you definitely want to have your proof of income, your pay stubs, W-2s, because the lenders may call to verify your employment. You want proof of assets, which are your bank statements, investment accounts. You want to have at least a decent credit score. Buyers with 760 plus get the best interest rates. Verification of employment. So like I mentioned earlier, lenders may call your employer to verify. And some other important documents like your photo ID, driver's license, your social security card. And some lenders ask for a rental history as well and gift letters. So those are some things that you should keep in mind when meeting your lender as well. So the process, you want to shop around for the best lender. You'll want to find a lender that is reputable, and you want to go to several lenders so that you can see and compare the best interest rates. Mortgage lenders are required to give you a loan estimate within 3 days of your application. So keep that in mind as well. So you want to compare different loan options. I've been going over the FHA loan, but there's also VA. If you're a military personnel, there's conventional mortgages, which typically it says that down payment is 20%, but you can actually get as low as 3% down on a conventional loan, depending on your credit score. And there's Home Ready, Home Possible loans, which are Fannie Mae and Freddie Mac loans, which require 620 plus for your credit score. So the process, you make sure that you read the fine print, look over your loan agreement carefully, look for red flags that signal predatory lending practices. And you also want to look into your terms, make sure that they're favorable. Like if they have late payment forgiveness, the ability to choose your payment date, direct payment for your creditors, and reporting good history to your credit bureaus. So the process, the final loan approval. Once you've chosen your lender and you've accepted an offer, some additional documentation that will be required are your driver's license, a passport, military ID, a document that verifies your address, your utility bill, lease agreement, and a document of your income. So W-2, pay stubs, bank statements, tax returns, and also the lender will run a hard credit check. So final approval, there's other documentation that may be required to close, a signed purchase agreement with the seller, W-2s for all employment going back 2 years, pay stubs for the last 30 days, bank statements for the last 60 days, tax returns going back 2 years, 1099 forms if you're self-employed, documented dividends, stock earnings, proof of bonus income, pension statements, securities, documents, social security or disability income award letters. So lenders use the 5 C's when evaluating you for your loan. And those 5 C's include your character, capacity to pay back the loan, the capital, the amount you have up front for a down payment, collateral, the asset you have to secure the loan, and conditions, the terms of your loan. And some final tips, be careful who you borrow from. So make sure that you do your research and shop around. Choose a reputable lender with no predatory practices. Be sure you can pay back your loan. And that goes back to making sure that you have a budget in place. Make sure that the payment fits into your budget and long-term plans, and take plenty of time to make your final decision. So that is everything.
One thing I did want to point out is that we did see there are certain credit requirements and there are certain debt to income requirements. And that should be noted that they're different on different types of loans, right? Each type of loan has their own unique set of criteria, which underscores the importance of working with a mortgage professional who knows their products well, and they can look at somebody's situation and figure out which type of loan best suits them, right? Okay, that was wonderful. Thanks, Crystal, again. We appreciate all of your expert guidance. And I'm going to dive now into a little bit about down payment assistance programs. What is a down payment assistance program? That is a program that allows you as the home buyer to be able to get into a home without using all of your own funds, but tap into another source of money that allows your purchase to be low cost for you with very little money out of pocket, sometimes none, which is great. There are some drawbacks. I mean, there's different pros and cons, but let me first do a little screen share here. So here's a worksheet from CDFI Springboard with various lender products. You can see again, there's loan programs from various cities, and there's also other nonprofit organizations. The funding varies. So as Chris was talking about earlier, and also Tina, about the funding for their programs, the USDA and CalHFA, they don't run out, but sometimes down payment assistance programs have limited funding for the year, and once it's used up, it's gone for that year, right? So you can see there's different types of purposes here. They have maximum for their loans. Now, again, the down payment assistance does not fund the entire purchase of the house, but it goes hand in hand with a specific mortgage product that your mortgage lender is helping you choose, because you're going to use this to supplement that loan. And a lot of times, as Tina was saying, it could be a silent second or a silent third on the property, right? They have a loan rate. There's a maximum term. The payments vary on those. And as I mentioned earlier, the income criteria. So for example, in this one, 120% of area median income or less. This one's 80%, right? Owner occupied. There are certain eligibility requirements. For example, on this one, the borrower must contribute 2% of their own funds. Owner occupied, most of them do have to be owner occupied. Some are limited to first-time home buyer, some are not. What is the definition of a first-time home buyer? Does it mean somebody who's buying a home for the very first time? Well, yes, but it could have other criteria as well. For example, a person who has not owned a home in the last 3 years may qualify as a first-time home buyer under many of these programs. Okay, there's some have a maximum home price, which varies. Geographic availability, this one, the Springboard Wish, is anywhere in the state of California. Okay, these ones, we can see the lien position can be, can vary, which is great. Let's keep going here. Okay, we do have some more information. This was the Neighborhood Lift program, and we have our friend Abina Briscoe Stevenson, who is a home mortgage consultant that presented this program about the Neighborhood Lift, which was part of the Wells Fargo Bank program. And we see here again, San Diego Housing Commission, first-time home buyer programs that are available, including down payment and deferred payment loans. And then again, we see another program called the Home Ownership Grant Program. So each of them have various benefits and maybe challenges or criteria that would have to be met. So again, it's best to refer to your real estate professional who would be more familiar with each of these programs and the benefits and, you know, the criteria required and whether or not you as a home buyer would be able to take advantage of each of these programs. Okay, so here we see another one. It's a first-time home buyer program from the city of San Diego. Okay, and again, it is limited by area median income, but you can see that some of these are actually pretty high. For example, the targeted program is 140% of area median income. So your income can be pretty high and still be able to qualify for these. Okay, so these are tax credits. And again, these may have tax implications. These may be for limited times. I'm not sure if these are still funding or have funds available, but this is just an example. Again, this was in 2015 to 2016 maximum income limits that were being used here. Okay, and different home buyer education providers. We have Springboard, Faith-Based Community Development, Nova Debt, ClearPoint Credit Counseling, Money Management International, and Framework Home Ownership. So just so many wonderful programs. And this one was from Springboard, which is a nonprofit consumer credit management company. And they're, again, based in San Diego, but there are many such programs. This is just an example. This one happens to be a HUD-approved housing counseling agency. We know that NAREB has another one as well, NID. N as in Nancy, I as in ice cream, D as in dog. So NID housing program is part of NAREB, and they also offer consumer credit counseling, home buyer assistance, and all of those types of things as well. I think that's about all I have to share. Okay, let's switch over now. I'm going to share my screen and we will bring Crystal in and talk about our financial education classes for the future. So we have financial intelligence training, monthly classes available at no cost to you. They are money empowerment classes to help you get started on the right track for your future. So we have various topics: tax refunds, as we talked about last month, credit report, which will be a future topic, down payment assistance and low down mortgage loans, which was this month's topic. Crystal, you want to tell us a little more about our financial intelligence training?
Okay, you can go forward. FIT course, so we're going to talk about the financial mindset, which is where everything starts in your mind. Your budgeting and saving will help you establish a budget and savings plan. We're going to help you get out of debt, put you on a plan to get out of debt, improve your credit score, and invest for your future. Oh, sorry. So we have 1-year membership scholarships available. So join us to take our FIT class or become a member with the Women's Council of NAREB.
Yes, and I wanted to point out, even though Women's Council of NAREB has the name Women's Council, we're not just for women, we're for everyone. We are an arm of National Association of Real Estate Brokers, and we are a group of people who are passionate and dedicated about helping everyone get better with their finances, move into a better financial situation for them and their family, and create generational wealth. And we have for our next topic next month, which will be very interesting, battle of the bank versus credit union. And which of them have the lowest fees and the best services to help you save the most money? So we'll have some special guests with us next month talking about banks, credit unions, and not just how to use them, but how to strategize so you can save the most amount of money for the future, spend less now, and save up for that dream home. Okay, and for those of us who are self-employed, the bank or credit union monthly statement is our key to filing our taxes, right? Because we use that to have a snapshot of our entire month or year that we send to the bookkeeper or accountant or tax preparer that helps us to be able to write off all those expenses so that we can have the most advantageous tax return, as we learned about last month. So mark your calendars. This month, we talked about down payment assistance. We showed you a lot of great tips. In April, our topic is battle of the bank versus credit union. In May, our topic is boosting your FICO score. And in June, we'll talk about building income streams for a lifetime. So mark your calendars for our upcoming workshops. Thank you so much for joining us at Women's Council of NAREB San Diego chapter, where our mission is home ownership financial literacy, and college scholarships. So in conclusion, thank you very much for joining us today. Stay focused on your goals.
Please join us for our next meeting next month.
Yay. Thank you, everybody. Bye. Thank you,
Bye.
Tina.
All right, bye.
Thanks, everybody.
Nice meeting you both.
Yes, and we look forward to working with you in the future, Tina.
All right, thank you so much again.
Okay, thank you. Bye-bye.
Bye.